Joining us now to discuss the crypto markets is Maple Finance Head of Capital Markets, Quinn Thompson. Welcome, Quinn.
Hey, guys. Thanks for having me.
Glad to have you here. So, of course, Federal Reserve Chair Jerome Powell, Jay Powell, is going to be speaking in front of Congress in the next couple of days, next 2 days. Does anyone care in the crypto markets? I mean, are we going to get anything out of this? No surprise. This is a pretty well telegraphed Fed. But on the other hand, after this meeting, 2 months of no meetings when it comes to the Fed. So, I mean, are we hoping we get an indication of just how extreme they might be, if at all, at the upcoming March meeting?
Yeah, I think in the grand scheme of things, it doesn't affect too much because they still have a long ways to go on hiking, and inflation has not showed any signs of slowing. When you talk about crypto in particular, looking back to November 2021, the peak of assets, it's traded in tandem with risk assets, equities in the tech sector, and in particular, with only decoupling risk to the downside. So the Celsius 3 arrows, the FTX events of 2022. And history shows December 2018, March 2020, and these macro type of events, it doesn't decouple to the upside until a Fed pause or pivot. And we know that that's, a good number of months at least away, just given where the inflation picture is. Yeah, exactly. They'll do it eventually, but just not as soon as all the market participants want it to happen.
Before I die, yeah. Another thing happening, of course, is that with rising rates, and for all those people who left business school wondering what WACC is, weighted average cost of capital. So with all these rising rates, that raises the cost of capital. You see that as a headwind here. What does it mean for crypto?
Yeah, I mean, when you talk about 0% interest rates effectively since 2009, that distorts a lot of things in the system. And so if I can't get anything better than 0 to 3% on my bond holdings or risk-free, I'm willing to take 7-8% expected equity returns, and for crypto even higher. But when risk-free rates are 5-6%, you have super secured corporate debt trading in the low double digits. If you're investing in risk assets right now, you're expecting 20 plus, 30 plus % of returns over an annual basis. And so I think it's just an extreme headwind as liquidity is coming out of the system. The Fed will have to remain higher for longer. And it's really due to this, diversion between CPI inflation, goods and services, and then asset inflation. And what the Fed can't control is the CPI, goods and services inflation. That's driven by large fiscal deficit spending, stimulus checks sent out through COVID, and the budget deficits remain at a 10 to 12% annualized basis of GDP. So that kind of puts a floor on base commodities, agricultural goods, and it's going to be a battle that's here for a while. And while rates are rising, people aren't looking to go out the risk curve.
All right. You also say that there's a higher global cost of capital that continues to be a headwind for technology and cryptocurrencies. Explain what you mean there.
Yeah, basically, I mean, there's a lot of investments that make sense when I only have to pay 3, 4, 5, 6% for the funding that is provided to me. But investors require now that risk-free. You need a spread up on top of the risk-free rate, and so. For the longer tail technology assets, even into the mega caps, they used to be able to finance themselves in the low single digits. And now, debt and other equity sources of funding, it all starts at the debt part of the capital structure and then equity on top. And so that cost of capital, investors' expected returns is to be a lot higher. Valuations have to come down for that to make sense over a multi-year investment horizon. And so types of businesses that might have made sense if it's effectively a 0% cost of capital, there's no downside. Let's give it a shot. There's a lot of businesses that, when you start having to require cash flows to pay down higher interest payments and return to your equity investors, they don't make so much sense. So you have to show that cash flow a lot earlier in today's market, which most of the technology and crypto sector unfortunately aren't doing.
Quickly, is there anything interesting to look at outside of Bitcoin, anything in the altcoin market that you're noticing, or specific tokens that people should be watching out for in the coming months?
Yeah, I think there's a kind of a consolidation. Obviously, the majors, Bitcoin and Ethereum, have really outperformed, and there's a significant narrative and meaningful structural tailwinds behind Ethereum over the next 12 to 18 months with Shanghai and a lot of the staking becoming liquid. I think on the further out the tail side, you have to kind of still boil back to the mission critical pieces of infrastructure. So there's been a lot of talks around the liquid staking derivatives, kind of the more basic primitives required to make the ecosystem function. I think the things on the longer tail of the spectrum are going to continue to struggle, the more speculative. And that's kind of the problem plaguing crypto right now is with on-chain activity lower, new addresses lower, there's not really an uptick in activity that coincides with an uptick in revenue. And so most protocols, projects, and startups in the space are facing a little bit of a crunch on the budget side, and I think it'll remain that way. And one of the other things is, unlike the equity markets or other more liquid trading asset classes, you don't have as much price discovery to the downside in crypto because it's very difficult to short assets. And so you have fund managers who maybe like to put, they run long short vehicles, they like to express a view to the downside, but there's just no way to do it. There's no borrow of the assets, and if you do it on exchange, you're taking a lot of risk because these things are illiquid and can squeeze in your face. So I think that's a theme we'll continue to see as a consolidation towards the major assets.
So real quick, Quinn, we're seeing, of course, Silvergate close down Sen, the settlement network it has. What do you think that will mean for stablecoins? People, Kaiko is predicting that it might be a boon for stablecoins, but of course, we're seeing some chaos going on with BUSD and the PEG BUSD. Is this really going to be all that helpful for the stablecoin business, given that those dollars need to be deposited somehow? And I guess that's going to be a little bit harder without Silvergate around.
Yeah, I mean, maybe on a very short-term time horizon, it's bullish stablecoins because, as you mentioned, a lot of market participants used the Sen network for quick transfers and settlement between trading venues. And with that gone, they're going to still require that quick settlement and transfer, and that's not going to be able to be done via fiat. And so just maintain their assets in stable USDC or Tether. Longer term, I think, stablecoins or digital dollars in general are, in my opinion, the most proven use case for blockchain technology globally. 114 countries representing over 95% of GDP are exploring some sort of digital currency. And so last year, you have the total crypto asset market cap down 60, 70%. The market cap for stablecoins was flat. USDC, the most kind of regulated or adopted in the States, was actually up in market cap. And so I think all roads really just lead to a proper stablecoin regulation. Many participants leaving Silvergate for Signature, is great on a relative basis for Signature, but it doesn't really improve the concentration or stability of the system. And so we just need regulations where something like a trusted regulated bank and redeem these stablecoins. And then you have a regulated product and it puts less concentration risk on the asset itself, right? Because there's clearly a use case. Every big payments company is incorporating every type of technology.
Quinn, we're going to wrap it there, but thank you for joining us this morning. That was Maple Finance Head of Capital Markets, Quinn Thompson.